for spread options as well as for butterfly options. SEBI has come out with new margin rules starting from June 1st. And we just looked at the various margin concepts for different types of strategies. Now we are carrying forward the same thing for stocks also. Okay. So today we will look at the margins as well as some strategies also. We will carry forward this discussion on strategies in coming sessions also. So we don't need to rush. The most important thing that we need to understand is how to make use of the margin requirements to construct strategies which are safe. At the same time, we make some money. Because it's very important that we preserve our capital. That was the underlying theme. And we also said last week that the underlying message from SEBI is risk protection. So those who protect themselves or hedge their positions are given low margins. And as far as the risky strategies, which are like a futures or naked sale of call or put, the margin requirements have been increased. We saw that for index, and today we will just look at for stocks as well. Now, if you look at the stocks, the futures margin is more or less the same. Not much of a difference as far as the futures margin is concerned. In fact, it is slightly reduced. Now we have put an illustration for State Bank of India. And State Bank of India, for one contract, it was something like 1,66,973 before June. And right now it's 1,63,875. So net and net, as far as SBI is concerned, as far as the futures is concerned, there is not much of a difference. Now, we have also said that okay, I think we will go with some illustration now. Let's say, I think the margin requirements have been laid in the Excel spreadsheet and it is now projected before you. Now, if you look at the State Bank of India call option, State Bank of India call option, previously the margin requirement is 1,83,695 and right now it's also remained as 1,83,840. So as far as the stock is concerned, what we can say is there is not much of a change as far as the margin requirement for futures or for naked sell or naked put writing. So there is not much of a difference. But where the difference comes is, as far as the options is concerned, the exposure margin now has been reduced to 3.5% for stocks. See, we saw for index it was 2% of the contract value, and for the stock it is 3.5%. Just as an illustration, if you are doing, say, Reliance, the price is approximately 1600 and contract size is, say, 500. So the contract size is 8 lakhs, quantity is 500 and contract value is 8 lakhs. Now 3.5% on this is the margin that is being charged now. So it's approximately something like 28,000 rupees is the margin that is required. 27k is the margin that is required for State Bank of India if you are going to do a spread option. Well, what we mean by spread option, we have already explained to you. Let us say you buy a 1600 call. You are buying 1600 call and you are selling a 1640 call. This is a spread option because one is that you are buying one option and selling option at a higher strike. Does it involve any risk it does not involve any risk because you are buying an option and selling an option of higher strike. So if at all Reliance fails to clear 1600 by the expiry day, then the maximum that you are going to lose is only the premium amount that you are paying. Let us say you are paid a difference of something like 20 rupees, illustration. For this spread, you are paid 20 rupees. So 20 into 500 will be approximately 10,000 rupees. 10k is what the premium that you are paid. So this is the maximum risk that you are going to take as far as Reliance is concerned. There is no further liability from you. That is what we are saying. It's an edged position. It is not a risky position. At any point of time, the maximum risk is restricted to 10,000 rupees. So in that particular case, in an ideal situation, there is no requirement for any margin, because once you have paid 10,000 rupees, like a normal call option, with no further liability from you, there is no necessity for anybody to pick up a margin from you, because the member is not going to suffer. But there is always a chance that somebody probably can take off the buy side and keep the sell side for the time being, and there will always be time for computational lag will be there. In order to ensure that a minimum amount of money is always kept to overcome this problem, SEBI has taken a margin which is approximately 3.5% of the contract, which is around 27,000. So there is no span margin in this. So you just need to pay 27,000 rupees. That is all for this. So the margin has come down very significantly from previous circumstances to a spread option of just 27,000 rupees. So if you do any multiple legs also, as far as spread is concerned, you don't need to look at any calculator. You just need to put 3.5% of the if there is any sell leg and if there is a buy leg. What you have to do is that on the sell leg you have to just compute 3.5% for the stocks, and that will be your margin. So the margin having got down very significantly, it has now become an incentive for participants to come and trade, provided you have a right strategy. So when we mean right strategy, you need to look at what probably can, for the less amount of money that you have, what strategy could probably optimize your returns or maximize your returns, whichever way you want to put it. We have also sounded a cautionary note. That's because the margin has come down. If you leverage yourself too much, because let's say last time you had 55,000 rupees, and 55,000 rupees you could do only one contract at that point of time. Now it has come to 27,000, so you can do two contracts. So that means the chances of loss also now increase, because in one contract the loss is going to be 10,000 rupees in this trade. That means you are going to put two contract size, then the loss can multiply to 20,000 rupees. So we need to be very careful to ensure that the amount of risk that we take is not high or disproportionate to capability. Just because the margin has come down does not mean that we should always take the risk. So what is more important is always the risk. Margin reduction is definitely a welcome thing. Okay. So you should know how best to use this margin without sacrificing on your risk reward ratio. So that is very, very crucial for any particular strategy. Now, the biggest reduction in margin has come as far as a butterfly is concerned. That is what we said earlier also. In the case of a butterfly in a 1:2:1, there is no span margin, and because there are two sell legs, now this will become 27,000 will become 54,000. Now one illustration I'll tell you. In the case of Reliance, what is the present margin requirement? Let us say you are doing a butterfly strategy. When you say butterfly strategy, I think we have already explained to you previously and also in last session also. Butterfly strategy, as Ian Condor some put it. So the butterfly strategy, let us say now Reliance is say 1600. So let us say you buy one quantity, that is 500 quantity. That is one quantity 500. That is call option. Now let us say 1640. You are selling 1000. That is 2 times of what you bought. 2 times of what you bought. Then again 1680. You are buying 500. So this is 1:2:1. That is, you bought 500, you sold 1000, and then you bought 500. So the one which you bought is the lower call option strike. The one which you sold is a middle level strike. And again, in order to ensure that you protect yourself, if Reliance is to rally above 1680, you are buying another call option out of the money, the same quantity as which you bought earlier. So this is called a butterfly, because you have, if this is called to be 1, this is 2, this is 1. So this is 1:2:1, butterfly strategy. Let us say in this entire thing you only pay a premium of 10 rupees. I am just giving an illustration, may be true or may not be true. Let us say you pay only 10 rupees. Now 10 into 500 is 5,000 rupees. So the maximum risk that you are going to have is 5,000 rupees, irrespective of where Reliance rallies or Reliance falls. So whether Reliance is going to come down to any level, or if Reliance is going to rally anything above anywhere above 1680, or if it is going to be stuck between 1600 and 1680, your maximum loss is just restricted to 10 rupees, which is 500 into 10 is 5,000 rupees. Let us say you are a passive trader. Normally butterfly works very well for passive traders and also works much better when it is about to expire, the contract is about to expire. So butterflies are generally more preferred for a weekend option because it is just going to expire immediately, more than for month end or for quarterly or other positions. It is always preferred where the decay is going to be quite fast. We have seen the characteristics of options earlier, what the decay means. So a particular option decays much faster, particularly if it is at the money, when it is closer to expiry. So now we are getting closer to expiry, means it is better to do this butterfly, because if the market is a little bit static, you would have earned your money. Even if it is going to rally or fall below, out of this particular range, the maximum loss is always picked. So let us say you are a type of trader who prefers this type of strategy because you have less time to trade the market in other ways. So you do this trade. Now first let us look at what is the margin that is required. The margin that is required is buy side you leave it, no span margin in this case. The sell side brings you margin of 3.5% on each contract. Now we have seen in each contract the margin comes to 27,000 rupees for Reliance. Since that is 1,000, which means 1,000 quantity means 2 contracts. So the margin that is required for this is 54,000. 54k is the margin that is required for Reliance in this trade. And the premium that you are going to pay is 10 into 500, which is 5,000 rupees. So 5,000 rupees is the margin that you are going to pay for this trade, and the margin that you are going to pay is for 54,000, and the premium that you are going to pay is 5,000 rupees. Now let us say you are able to get a profit of only 10 rupees. That is the 10 rupees premium that you are paying, and you are getting a profit of 10 rupees, which means you will get a profit of 5,000 rupees, right? So 5,000 rupees you will get a profit. 10 rupees profit you are getting at some stage during the period of the option period. So you are getting 5,000 rupees. What is the investment that you have put is 54,000 rupees only. So a 5,000 rupees on a 54,000 rupees is a fantastic return, right, for that particular month. For that particular month it is going to be a fantastic return. Okay. So these type of trades are quite passive and can give you, because it is not something which very aggressive or a firebrand trader would prefer, because it will move very slowly. The profit will come very slowly. The 10 rupees will become 11, 12, and then probably to hedge it to 20 rupees will take time. But you don't need to be bothered too much about this trade, because anyway this trade is risk contained, very well risk contained, and you can just move on to your other activity or probably do another trade. So this type of trade should be in your trading arsenal. And only thing is you must know when to use this type of option, when to use butterfly type of option. Now we have already illustrated before also that the butterfly option is better to be used during the weekend, for weekend options. It is better to use butterfly option. Okay, so the decay will come quite fast. Now if you look at the present situation also, probably you do a Nifty or you do a back Nifty, or you do a stock. Stock we don't have a weekly option, we have only for Nifty and back Nifty. So for the stock means you have to do, suppose if this month is going to expire on 25th, you should consider after 15th or so, you should consider butterfly type of option in these type of scripts. Now, for a Nifty and Bank Nifty, now let us say today is Monday, you can do even for tomorrow. Tomorrow you can do for a week, for a Thursday expiry. You can usually do it for a Thursday expiry tomorrow. Okay. So, after this Thursday expiry, you can just do it for the next Thursday. So, you can just concentrate the weekly options in Nifty and Bank Nifty can be very productively used for this type of strategy. And if you are containing the risk, then in that case you can do any amount of volume, because if you know that probably your risk can be addressed, which we'll also highlight, then in that case you can put more number of contracts, because your loss is going to be reduced very significantly, or your loss is going to become nil by some strategies which we will tell you. Then in that case it will induce you to put more trades, particularly in the case of I would prefer say Bank Nifty or Nifty. Both these stocks are appropriate for this type of options. And also butterfly option is also helpful for those type of stocks which are range bound, which are slightly range bound rather than flying stocks. Bank Nifty you have to do it carefully, because you have to strategize as well, because Bank Nifty moves heavily, and for which you need some sort of adjustments and some sort of strategy which you have to slightly innovate within this butterfly. But if it is range bound stock means I would say TCS, say Infosys, these type of stocks don't move that much, right? So these type of stocks are a little more contained movement is there in these stocks. It doesn't move except during results time. These stocks don't fly much. So we should look at stocks which are range bound, and for those type of stocks, I think we should be looking towards butterfly type of option. Okay, so it should expire fast. It should also be a range bound type of stock. So for which we should qualify, that is just 1 week, 10 days before, let us look at stocks which are range bound. Okay, and in those range bound stocks, let's try to do that. Probably we have to do something like Infosys, TCS. So these type of stocks are something which we have to do. But other than this, we have to also look at whether there's some stocks before expiration and all. We have to look at for delivery. All those other technical formalities are there. We will not touch this. For the time being, as a concept, we will understand that this works very well in the case of a range bound stock, and also for expiries which are going to happen at the earliest, immediately. So in a way, Nifty also is not as fast moving as Bank Nifty is. So certain estimation of the particular range can be made in Nifty. So you can do the butterfly within that particular range. So now we will look at how exactly to pick up spreads, because today's discussion we have said that we will highlight initially the margin requirements. Now we have already explained to you in a very simple thing, that as far as the stocks is concerned, the futures, the margin requirement for futures and as well as for at the money call and put has not changed much. Even in the case of index it is like that, except index the futures margin is slightly more by 10%. Where the case of futures, in the case of call or put option, if you sell out of the money, then in the case of the index, the margin requirement has become slightly or much higher compared to prior June levels. Similar thing as far as the stocks is concerned. So at the money, not much of a difference. Out of the money, it has increased. Now, as far as the options are concerned, in the case of spread and butterfly, almost the span margin has ceased to exist, and in the exposure margin, which is charged only on the contract value, it is 2% for the index and 3.5% for the stocks. So very clear now as far as the margin is concerned, and the reduction of margin enables even marginally funded players also to step in and try out the options, learn, okay, so that it does not become very costly mistake. You can always innovate with small losses and come out with better strategies, and when it works, then you can go for higher quantity. Now, the entire exercise of this webinar also is to give you the confidence in various types of strategies. So you should always ponder over and then work out some strategies which will definitely suit your personality. We have already highlighted that it is always better to go with the trend, right? So now we will look at how to position ourselves in this. Okay. Now, okay. First thing that we have to do is identify the trend. What is the trend? Whether it is up or down. We have already had sessions on this, and so many of our webinar speakers have already identified how to go on the buy side and how to go on the short side. And trend identification has been done through various types of theories like higher bottoms, higher tops, then through moving averages. So there are various techniques where a trend identification has been done. We will not go into that today, but just to say that the first thing that you have to do, the first checkpoint that you have to do for any strategy is you should know which side you should go, right? There are neutral strategies also, we'll come to that. Let us say you want to be on the bullish side of the market or bearish side of the market. So you should identify whether it is bullish, bearish, or you feel it is neutral, whichever way you think about it. So this is one first thing that you need to do. Second thing is, you are selecting an expiry period, right? So it could be weekly or monthly. So you are going to do an option for weekly or monthly, right? So you must also know to what extent, even if it is going to be on the upside or downside, an estimation of the likely movement. Because for a butterfly and all, you need to put in a strike, or even for spread, you need to put in select a strike, and then the spread strikes. That is one strike, then another strike for a spread, right? In the case of butterfly, you need to select 3 strikes. So in order to identify the strikes, we should know first which one we are going to take, weekly or monthly option. And third thing is, what is the range that is you are estimating for the movement? What is the range that you are expecting now? That is on the upside or on the downside. What is the range that you are expecting for Nifty? Now then you have to look at how the trend is for, as far as Nifty is concerned. Now we know very well that Nifty now, of course, it is on the bullish side. So for at least the last 1-2 months, and so the market you now prefer that to be on the upside. But there are always contrarian views saying that it has already rallied significantly. So how much it can rally? So there can be always a debate on that. And also you must know which type of trend you are picking. Whether you are picking a monthly trend, weekly trend, daily trend, intraday trend. So it's all based on different types of time frames also. But as an illustration, just to say that recently, couple of days back, Nifty touched 9950 or so, right? It fell from 10,150, then came down to 9950, and then today it went up about 10,300. Somewhere it closed around 10,170, 180 levels. So let us say 9950 is a temporary bottom, because that was that low which was made a couple of days back, 2 days back or so. So 9950 is a low. So as long as 9950 is not penetrated in Nifty on the downside, let us say we are bullish. Okay. Now you are taking a weekly option. So now you are asking, butterfly, okay, I will do, but what strikes I should choose? That means what is the range probability that I am expecting for butterfly, so that I can choose those particular strikes where the Nifty gentle base, so that is has very less chance of moving above that particular strikes or below that particular strike. So it should be in between that. This is what probably we would like to assess. Now let us say 9950 or so is a general is a bottom that has been made. Now to what extent, let us say, okay, we are confident that as long as it does not go below 9950, the trend is up, so we want to be on the bullish side of butterfly. So bullish butterfly we want to do, let us say. So which strike you are going to choose will depend on the last, that is whether Nifty will exceed which particular strike, so that we will construct the third leg of the butterfly to contain this particular movement of Nifty. Let us say if I am going to say Nifty is going to cross 10,500, there's no point in my having the third leg at 10,400, because it is not going to pay me money. If I say Nifty will not exceed 10,500, then I will put the third leg at 10,500. So all these are only rough estimation, for which we again depend on the chart or on the Fibonacci retracements or important support resistance levels for all those things. So let us now look at Nifty somewhere between 10,100 to 10,500. So why am I saying this between 10,100 and 10,500? Let us say. Now, if you look at the option price, it will give us some idea. Now, let's look at the option, this one, just for illustration purpose. Now, slow. Okay. Okay. So this is for the 11th June expiry. That is for this week. Now let's look at generally if you look at it, we also look at the open interest sides. Okay. To give an interest, to give some estimation of where probably Nifty will have big resistance. Now, because of the white background, I'll just read it out for you. 10,400 and 10,500 approximately as the maximum open interest on the upside, which means generally speaking, Nifty may trade below 10.4, may end below 10.4 or 10.5 in this week. Similarly, if you look at the downside, which is the maximum open interest is around 10,000. So that means 10,000 to 10,400 or 10,000 to 10,500 is what probably the market expectation at this particular point of time. Also, if you look at the option price, approximately 10,150 where it is, the option price on average is something like 110 rupees. So 110 rupees into, suppose if we put into 3, that is because normally we have a range which is, if you take it for the entire volatility, because this is all based on volatility calculations. We have already explained also in previous webinars, we will again explain later on. But today the session is just to concentrate upon how to construct a butterfly spread or a spread option, what strikes we should choose. Now for which we have assumed, based on the open interest, we found out that it is between 10,000 and 10,400 or 10,000 to 10,500. Based on the option price also, it's approximately 300 rupees from the present level. That is, if it is not going to fall and it is only going to rally, it will be approximately 300 rupees. So we can say if 10.1 is going to come, it's touched 10.1 to 10.4, okay, 10.1 to 10.4 or 10.1 to 10.5. Let's say that particular area is probably where Nifty is likely to trade. Let us say we say 10.1 to 10.4, or probably we say it could be 10,000 to 10,400. This is what a probable calculation can be. So let us do the calculation between, I would say 10.1 to 10.5. Let us try to be on the safe side. So 10.1 option right now is 151, and 10.3 is around 56, and 10.5 is 18. So we will do this. So 150, 56 and 19. 151, 56 and 19. So it's again problem there. Okay. So 10,100 is around 150. 10,300 is approximately, I think, 55, and 10,500 is 19. So this is the butterfly, and now we have guided you on how to choose the strikes, because estimating between 10,000 and 10,400 or 10,000 to 10,500, and we have picked it between 10.1 and 10.5. Now this is 150, this is 55 into 2, we will do it. This is 19. So this is 110. So 140, 59 rupees. So you will now, for the remaining period, you will pay 59 rupees as the premium. 59 rupees is where you will now pay the premium for this butterfly between 10.1 and 10.5. So the maximum loss is going to be around 59 rupees. That is, even if it is going to go above 10.5 or if it is going to fall below 10,100, the maximum loss is 59. So 75 into 59, approximately something like 4,000 and odd rupees. And the margin that is required is 2 times we have to put it here. So one contract is approximately 7,50,000, 15,000, 30,000 rupees approximately will be the margin. We may have to pay 4,000 rupees as the premium in this case. So in case if we get even a 10 rupees or 15 rupees profit, it's going to work out to be a fantastic return on investment. So 10,100 to 10,500 is what we are going to look at for a 59 rupees as the option premium. Now for those who are very conservative, now let us say we expect the market not to be about 10.5, so on the upside I will leave it for the time being. I will not dwell too much on complicating this by putting the strikes at different levels. But what I am saying is that if you are very conservative, that is, you don't want to even lose the 59 rupees if the market goes down, because you feel the market can be between 10.1 and 10.5, you will be able to recoup that 59 rupees. So what if it going to below 10.1? Okay. Now there are two alternatives. One is if the market is going to sink below 9,950, because you know the maximum loss is only 59, and that the important low right now for the time being is 99.50. So you can keep a stop loss for 99.50 in case if it is going to fall below 99.50 levels. This will have definitely some value. This will have some value at that point of time. It could be 20 rupees or 25 rupees unless it comes to the last day. Unless it comes on the last day, the 99.50 is crossed. So tomorrow or day after tomorrow, if it is going to break below that, in that case you will have some 20-25 rupees. You can always come out of the structure with a smaller loss in case if it goes below 99.50. That is one. Second alternative that you can do, that you will not be able to react to that particular situation. So what you can do is that you can always not edge this particular thing. You can, along with this, you can go for a 10,000, 9,900 put buy, because you can recover the premium in case if the market is going to fall. So 10,000 and 9,900 put spread. So let's look at what the put spread means there. What is the premium there? See, 10,000 put right now is going at 48 and 9,900 put is 28. So approximately it's around 20 rupees. You can say 48 minus 19 rupees or so. 19 rupees or so is the premium there. So this is 19 rupees. You don't need to do one full under this for 19 rupees. What you can do is that you just need approximately 59 rupees to be recovered. 59 rupees to be recovered. So what you can do is that you can do, suppose if you do 10 contracts here, let us say 10 contract size you do, in that case I suggest that you do 6 contracts here. Because when you do 6 contracts here, the premium that you are paying is 19 rupees, so approximately 20 I would say. So 20 into 6 times approximately 12 rupees. So you add 59 plus another 12 rupees, you have to add the premium for this particular structure. So 59 is going to become 71. But in case the market is going to slide down completely, then in that case you will recover the 60 rupees. You will recover the 60 rupees and probably the loss could come approximately to 12 rupees, because you have paid 71 rupees as the premium. So you will recover 60 rupees and something like 11 rupees or 12 rupees will be the maximum loss instead of 59 rupees. So that means now you are almost, you are a little more certain, and because you are a little more certain, I think probably you will feel more confident that even irrespective of even if the market is going to go down, you are going to recover substantial amount of the premium. Only 11 and 12 rupees is going to be the loss. It will entice you to do more trades. It will entice you to do more trades or increase the quantity, because here also the margin is not going to be much. It's only 15,000 rupees. So even add this particular margin, and for the return that you're going to get is going to be very fantastic. So I think this butterfly option with a probable edge at the lower level, will give you, because you will know that those number of days, you're not going to wait for a long time. It's only 3 days, right? It's only going to be 3 days. So you'll know the result within 3 days. And in this 3 days, this particular structure, this particular thing is going to lose only 12 rupees. It's going to go no, only 12 rupees. So you have to see whether the market is between 10.1 and 10.5. And somewhere in between that, you are sure to recover the 60-70 rupees, or sure to recover the 60-70 rupees. So it's obviously a very calibrated, fund-based, because last time itself we said very clearly that if you make money, you try to make money, okay? And you should always look at some sort of a return on investment rather than looking for huge profits, for which also we will do some trades, for which also we'll suggest different types of trades. But let us say you are a very now this particular thing is very for a conservative trader, because you want to conserve capital, particularly in these trying times when a lot of problems are there, when money has to be saved very carefully. So what is the strategy that will enable you to save money, and what is that particular strategy which probably can give an investment on the return that you are putting, and what is the strategy which will not give you sleepless nights? Because here is a strategy where you don't need to think about too much of this one, that is, you know that anyway between 10.1 and 10.5 it's going to be, and now market is close to 10.170. It will give you some time to adjust in case if it starts going about 10.5. Probably you can look at these. Suppose if it is going to fly tomorrow about 10.5 suddenly, then in that case, if it is around 60-70 rupees, since you feel it's flying off, you can always remove the trade and come out. If it is going to fall down significantly due to some reason, you have got a put spread there to save you, and your maximum loss is 10-11 rupees. If it is going to be static, you are definitely going to make money in this. If it is anyway between 10.1 and 10.5, you are sure going to make. So if it is static between 10.1 and 10.5, you are going to make money. If it is going to fall very deeply, you will lose only 10-11 rupees. If it is going to cross 10.5, you will have time to ensure that you come out of this structure without loss. So what more you want? So it's a very carefully structured trade where probably the chances of loss is quite low, and which gives you a very decent ability to come out with profits. So I suggest that we should look at this type of strategy butterfly, and we must understand of how to choose that particular strikes based on the trend that we are in. Suppose if the present trend is bullish, suppose if the market is going to go below 99.50, we have the put spread. So one is, we must always look at risk mitigation irrespective of our ability to gauge the trend, knowing well that the market is likely to be on the upside. But still, anything can happen. That for a situation like thinking that anything can happen overnight, we have seen dramatic changes also taking place. In order to protect ourselves, we need to do the opposite side. Okay, because for a weekend butterfly, if the market starts moving lower immediately, this structure will not have much of there will be some money left. Some premium left for you to take it out. But sometimes if it falls a little deeply, say on Wednesday or Thursday, you will not have much of this one, that is to come out of it. So for which the opposite side put is also very important. Now if you don't do this, probably this will give more profit. Probably if you don't do the put side, that 10-12 rupees will add to this and give more profit. But that's the compromise. Always traders should always, I think the best thing is always not to look for too much of a profit, but to accept a compromised trade in which probably you will make some money. You will make some money, okay? And probably if you will lose very low. You will lose low, because if you lose 10-11 rupees, you will bounce back rather than even 59-60 rupees, right? So you know that it has worked out, and this is the best thing that you could have done, and you have almost protected your capital there. Okay, 10 rupees you have lost, and for a 75 contract trade, probably whatever it is, it could be just 750 rupees instead of losing 4,000 rupees or so. So as far as possible, keep your losses very low and ensure that your capital is protected. That's the most important thing, that initially we need to look towards that. And once that is there, then slowly, suppose if the market is a little more static tomorrow, we will get more money. So whenever you get some, because you are taking loss of not more than 10 rupees, whenever you get 10, 11 rupees or 15 rupees in this trade itself, you can take profits, and that is good for the total return that you are going to get. It's quite fantastic. It's going to be very, very cheesy. Now, the spread also, now Now we have highlighted for butterfly how to choose the spreads. Okay, this is for index we have done. The same thing we can do for stocks also, which I told you that probably we have to look at say we said Reliance. Now Reliance stock as such, 1610, 1615 is facing a huge resistance, right? So every time it goes to 1610, 3-4 times it has got pushed lower. So we're not very sure whether this will cross 1610, whether it's going to cross 1610. Same time, right now it looks as if it started its rally from 1390. So from 1390 it has gone to 1610, which is more than 200 rupees. So in a monthly thing, approximately Reliance, abnormal circumstances only will be more than 200 rupees. So probably it has, I feel it has reached its peak for this month, unless there are other fundamental factors which can drive Reliance above 1610. And so 1610, if you look at it, then what probably we can look at this particular strip is that it is also possible that Reliance could be between 1500 and 1600. Let us say 1500 and 1620. So what you can do is that you can buy a 1500 call, okay, and you can sell one quantity, that is 500. Then 1560 call, you can sell two, that is 1000. Sorry, because of the gloves I'm finding it difficult to write, please bear with me. So 1000. Now 1620 call 1, it is 500 quantity. So you can do this trade as 1500 call, you can buy quantity 500, 1560 call you can sell twice, that is 1000, and 1620 call you can buy one lot, that is 500 quantity. This premium is approximately 12 rupees. This premium is 12 rupees. And you will pay a premium which is margin is on 54,000 rupees. Now for 12 rupees, there's a good chance that Reliance could be between 1500 and 1620, because 1620 is a very decent high right now. Because it has been curtailing that. If it starts going above 1620, 1625, I suggest that we exit this trade with marginal loss or profit also may be there. We exit the trade. Now, very clearly that possibility that 1500, 1560 and 1620 can be there. And this is just around approximately, it's just around 12 rupees trade. And this 12 rupees can become around say 20 rupees or 25 rupees. Now, I'm not putting any opposite side put or put spread or anything like that, because if it starts moving much below 1500 also, let us look at what the price at that point of time and we can exit. Because generally, Reliance at this point of time, we should expect the Reliance to hold above 1500 in the present juncture in this month. So if it starts to move below 1500, I think we will put a stop loss and come out of this trade. At the time itself also this will not go much below 12 rupees, because there will be a lot of decay also there left, and so will not. So if it's cross above 1620 also will come out. So this is a very decent structure which you can think about. And even if this 12 rupees is going to become 20, a little slower, because you've got 2 more weeks left, and if it is going to come a little slower also, it is much better, because you can have the 12 rupees going to 20 rupees or 21 rupees, then you will have 10 rupees into 500 is 5,000 rupees on 55,000. The return is going to be very high. So this is one strategy where we have chosen the 1620, the strike, based on the resistance that Reliance is having at 1620, and from the reverse side of 1620, expecting that 1500 is an unlikely scenario for the time being, we are putting this. So why do we choose? This 1500 as the point. It has rallied from 1400. Presently, if you look at it, it has rallied from 1400 to 1500, 1600. 50% retracement of that is something like 1500. So generally speaking, that it should not have much of a fall below that particular for the time being. Below which means probably it is, I think the bullish momentum has faded, we can say, for a fall back to 1390 or 1400. So in that particular case, we can even come out of the structure with 1 or 2 rupees loss, or probably even at some profits also. So this structure, which I think probably we should look at this particular structure. and decide about how exactly we can make money in this. So this is one structure which I will I will just tick on this particular structure for Reliance. Now, when you do the spread option, also I told you that the spread option we have to choose also based on what is the area of resistance that the market expects. So here very clearly now, if you see in the case of Nifty, we have seen that the level is 10.3, 10.4, and 10.5. So if we do a spread option, I think the maximum that we should do is something between 10.1 and 10.2 or 10.2 and 10.3 on the bullish side, because expecting much about 10.4, 10.5, I think the market has already rallied, because if you look at this particular month itself, the last 2 weeks Nifty has rallied from 9,000 to 10,300. So I think the rally of more than 1,300, 1,400 points in the bullish trend normally doesn't happen, because in the case of bearish trend, normally the fall can be very steep. We saw in February, March also. But 1,300, 1,400 points is slightly on the heavy side of Nifty rally. So at the same time, probably the overall global cues are good. So I think the market is looking still better. So we should expect probably 10.4, between 10.4 and 10.5 to offer resistance. So at the maximum, I think we should confine ourselves to 10.1 to 10.2 spread, or 10.2 to 10.3. So 10.2 to 10.3 approximately will be something like 40-45 rupees. So the maximum loss could be 40-45 rupees. And the profit if it comes could be 20-25 rupees, because I think the moment it moves about 10.4, I think we should be in a position to take the profit and come out. Definitely there will be some reaction somewhere very close to that particular level of 10.4, 10.5, from where probably we could expect some sort of a fallback to come. So we should be very careful about this 10.4, 10.5 range. So in case if it starts pushing itself about to 10.4, 10.5, I think we should come out of the trade. So these are the type of option strategies. The butterfly and spread option we discussed, and also which strikes that we should choose and what is the margin. So we gave 2 illustrations as far as the weekly position as far as Nifty is concerned, as far as the Reliance for the monthly option is concerned. So this is not exhaustive, because there are different strategies we want to explain to you. Probably we look at straddle strategies and what are the normal problems in the straddle strategy and how to overcome. So this is very going to be important. That is, in the coming session we will discuss about the straddle strategy, and also look at how the strategy can be constructed in different ways. So a couple of these strategies we will highlight to you from our own experience, and we will look at all these things in coming sessions. So now the time is 7:50, so I will leave it to you for this question answer session. So the question is butterfly strategy, when is it going to be useful more for weekly or monthly? Butterfly strategy for weekly, because the decay is fast. So we should do butterfly for 2 types. That is, when the decay is fast we should do, and also we should do for range bound strategy. So the 2 range bound stocks. Now illustration also I have already given to you. Now, so we should do butterfly for stocks. If it is due, then we should do for range bound stocks, butterfly. Second thing is that we can do weekly, because it is going to expire quite fast, because you will see the result and do it off. So okay, so these are 2 things that we should look at it. Now third is how to choose strikes. Choose strikes. right? So Nifty we have already chosen. So this is range bound stock, weekly expiry, and what type of strikes that we should choose. Assuming that we are taking Nifty now, in this case, so Nifty, what we are going to do is, sorry, okay. So for Nifty, the strikes that we are choosing depends on the open interest. Now, if you look at the NSE website, you've seen that the maximum amount of open interest on the upside is on 10.4 and on 10.5 call. These are the maximum open interest positions. Similarly, on the downside, on the put side, it is 10,000 strikes. So we should put in our strikes between this. So you can look at something like 10,000, 10.2 and 10.4. So this approximately today is also around 57 rupees or so. Today is 10,200, 10,400 is also approximately 57 rupees. So anywhere between 10,000 to 10,400, I think we are going to make money here. Okay. If it starts going below 10,000, you just leave the trade, or as I suggested, you just construct a put spread on the downside. Put spread on the downside. Okay. So that is also a possibility that you can think about it. Now, if it is, if the decay is there, suppose say one day, tomorrow, right? So morning, so I don't know tomorrow morning whether this price will hold, but today let us say you have done that, and tomorrow it is static, you will get some 4-5 rupees. And if it slightly boosts up also, you will get a little more money. So by that you get 10 rupees or so, okay. And if you put say 1:2:1, so for 75 rupees you can get 750 rupees or 1000 rupees is a possibility. And investment is quite low, right? Only 30,000 rupees. So even if you make something like say 10,000 rupees in the 1,000 rupees in the trade, the return is quite fabulous, right? 3% per month or so. So to that extent, the return on a weekly butterfly option in a very contained premium paid option, I think it can work out very well. Thank you for participating in this webinar. I think we hope to see you again on Friday. Thank you very much.